The Purpose Tactical Asset Allocation Fund is a diverse portfolio that can move through both equities and bonds to navigate evolving markets. It's a mostly rules-based strategy to strip out emotional decision-making, but there's some room for our discretion to find the best opportunities. The idea is to reduce the risk in your overall portfolio with a tactical strategy that rotates between asset classes depending on market conditions. We created the strategy with the premise that markets have evolved and are now more volatile with bigger swings both up and down. And in this market environment, a static or fixed asset allocation approach appears ill-equipped. Most investors determine their asset allocation based on their long-term goals and objectives. Once determined, it is often a set-it-and-forget-it approach, perhaps revisited annually. Our tactical strategy was developed to complement a statically allocated portfolio and provide a tactical component. Not to diverge materially from the long-term allocation based on your investment objectives, but to tilt with a little more equity when markets are trending higher and tilt it to be more defensive when markets are weakening. To do this, the fund can oscillate between 100% equity to 100% bonds using broad-based ETFs. It is a rules-based strategy designed to tilt more towards equities in upward trending markets and more towards bonds when equity markets are trending down. The rules or signals that trigger portfolio changes are hard-coded to remove human emotion from the decision-making process. It is not the portfolio management teams altering their asset mix based on their view of the market and what they think is going to happen. It is the signals changing as the market is losing or gaining momentum in one direction or the other. Since launching, we have found the signals are quick enough to help the portfolio become rather defensive when markets get into trouble, the time you need a stabilizer for your portfolio. And meanwhile, trying to capture gains in upward moving markets is important. But more important, avoiding big downdrafts is the primary objective of how we created the strategy. Markets have changed, often moving faster and in bigger swings than before. In this environment, we believe adding a tactical component to a portfolio can help mitigate the portfolio damage in bad markets without sacrificing too much during good times.